Good news. Okay. You have classes on 26th from 1 to 4. Bad first. Okay, you will get the bad news also. 7th March, no classes. 14th March, no classes. So in fact, the schedule will be 26th March, 1 to 4. Then we will meet on 28th, 3:30, 5:30. 7th March, no classes. 14th March, no classes. So this will be 1 to 5. Right, so 26 March, 1 to 5. Next week, business as usual. The weeks after that, we are not going to meet. Then 21st March, 3:30, 5:30. Right. Hope that's clear. So we were on to fixed income securities first. Right. We discuss some of the risks. Primary and secondary markets. We did the security identification. The bond terminology. Par value, which is the value you receive when it matures. Coupon is the periodic interest payment. Zero coupon bonds carry no coupons. Then the price of a bond is the present value of cash flows. We did a price calculation. This is the formula which you need not memorize. Then we discussed discounts and premiums. Term to maturity. And we did day count basis. Right, so I believe we discussed amortization, then skipped the securities. Now all bonds and bills, government securities are electronic. Right? So there is no script. You won't receive a script. And this is where we stopped with the yield to maturity. Any questions from last week? No questions? Right. So let's move on. Yield to maturity. Can you all remember the concept of internal rate of return or IRR? Very quickly, right? This is a 3-year bond. This is a 3-year bond, and if you are paid coupons of, let's say, 10, annual coupons of 10, and the face value of 100, even for cash flow. This much. Right. And let's assume you are buying this bond at a price of 90, right? So you have purchased this bond at a price of 90. Now this price that you buy the bond, you are paying it today. Sorry, I wrote it in the wrong place. You're buying it today, right? So you're paying 90 today, meaning there is an outflow of 90 today. And you get coupons of 10, 10, and coupon plus the face value of 110 when it matures, right? So if you look at these cash flows, you have an outflow followed by a series of inflows. This is the normal cash flow. Can you remember normal and non-normal cash flows? Right? This is a normal cash flow. So if you have a normal cash flow, you can calculate the IRR, the internal rate of return. Right? Remember, it's the discount rate at which the net present value is 0. Right? So let's say the discount rate is R. If IRR is 0, right, you will get net present value is minus 90 plus 10 over 1 plus R plus 10 over 1 plus R square plus 10 over 1 plus R cube, which is 0 because you are discounting at the IRR. That's why let me write this as IRR. So you get 10 over 1 plus ARR So solving for IRR will give you a certain figure, right? Let's say IRR will get as 13%. Now this 13% is the return that you get on this bond. It's called the yield. Or the return on this bond. It's called the yield. Okay. So in other words, the return that you get on a bond or an investment is called the yield. All right. There are several types of yields which you can calculate. First one is called the current yield. The bond interest rate as a percentage of current price of the bond. In other words, the coupon as a percentage of the price of the bond. In this case, current yield will be coupon is 10, price is 90, so this will give current yield. Then the yield to maturity. It is a measure of return on the bond if it is held until the maturity date. So if you buy this bond and you hold it until it matures, if you buy this bond and you hold it until it matures, the return that you generate is called the yield to maturity. Right? So remember, yield to maturity means if you hold until maturity, how much of return do you get? Yield to maturity calculation takes into account the current market price, par value of the bond, and coupon interest, and the time until it matures. Right, so it's the IRR in other words. The important assumption is that it assumes coupons are invested at the same rate at the IRR. So the bond price relationship. Have a look at this graph. You will notice that it is almost a mirror image or an inverse relationship between price and yield. So inverse relationship, there is an inverse relationship between the price and yield, obviously, right? Because if you go back to the equation, inverse relationship between the price and the yield. So the green indicates yield and red indicates the price. So if you go back to the price and yield, you will see that higher the yield, lower the bond price, and lower the yield, higher the bond price. Okay, so that's why the negative or the inverse relationship. Then accrued interest on this coupon. In this example, the coupon is 10, right? And the 10 is evenly distributed during the year. That means throughout the year you get 10. For a year you get 10. For each day you get 10 over 365. Right? Accrued interest is earned on a daily basis, on a straight line basis. It's the accrued interest is the interest earned but not yet paid. Now, if you look at this example, okay, A buys a bond, has bought a bond on 1st January 2010, and A sold it to B on 1st March 2010. Right, so A had owned it for the first 3 months, for the first 2 months, sorry. Then B has bought it on 1st of March, and the next coupon date is the 1st of July. So he has held on until the next coupon date. Now B will be getting the coupon because the coupon will be paid on 1st July, so B gets the coupon. But A has held on to the bond for 2 months. B has had it for 4 months, right? And the coupon in this case is semi-annual, so that's why it's paid in 6 months. Now A should get 2 months of the 6 months coupon, because A had it for 2 months, and then B gets it for 4 months. That's called the accrued interest. Accrued interest of B will be 2 months interest, because he has to pay that 2 months to A. Clean price of a bond is the bond price without accrued interest. Right? So there are two prices of a bond. One is clean price, other one is dirty price. If you don't include the clean price, if you don't include accrued interest, it's called the clean price without accrued interest. Whereas dirty price or the full price includes accrued interest. It is clean price plus accrued interest. Right? Dirty price is the price that you actually pay, is the clean price plus accrued interest. Bonds with options. Since we have not done options, let us skip this. We'll just go through, but we'll not go into detail. Bullet bonds are non-callable, regular coupon-paying debt instruments with a single repayment of principal on the maturity date. Right, non-callable. That means a callable bond is where the issuer will call back the bond if interest rates drop. Right, so the issuer will benefit if interest rates drop. So it's a bullet bond is a non-callable, regular coupon-paying debt instrument with a single repayment of principal on the maturity date. That means there are no coupon, like a zero coupon bond. Callable bonds are bonds that can be redeemed by the issuer prior to its maturity. Okay, so if interest rates drop, the issuer will call back the bond. That's called callable bonds. Usually premium is paid to the bond owner when the bond is called. A premium has to be paid to the bond owner when the bond is called. Right? Meaning, if interest rates start dropping, the issuer will call the bond back, and for that he has to pay a premium to the seller. Main reason for issuing callable bond is to take advantages of declining interest rates. When interest rates drop, you will benefit if you have issued callable bonds. Puttable bonds will benefit the lender, because if interest rates go up, he gets an opportunity to sell. A bond that allows the holder to force the issuer to repurchase the security at specified dates before the maturity date. And it's a bond that allows the holder, that means the investor, to force the issuer or the borrower to repurchase the security. Right? He will sell it if he feels interest rates are going up. He will sell it and reinvest at a higher rate. Right? Whereas callable bonds, if interest rates are going down, right? Callable bonds, if interest rates are going down, the borrower will want to refinance at a lower rate. Right? He will want to reduce cost and refinance at a lower rate. Okay, so what he will do is he will get the lender to sell it back to him. He will call the bonds back. But if it's a puttable bond, it benefits the investor, because if interest rates are moving up, the investor will want to sell this bond that was purchased at low yield and reinvest at a higher yield. Right. So remember, puttable bonds will trade at a premium, callable bonds will trade at a discount. Okay, we will get back to that later. I will explain why once we do bonds. A puttable bond is a bond that allows the holder to force the issuer to repurchase the security at a specified date before maturity. Right? So if interest rates go up, he will simply sell it to the issuer. Repurchase price is usually set at the time of issue and is usually par value. Then related products which are based on fixed income securities, repurchase agreements or repos. Now this is where if you have excess security, right, and you're short of funds, you need to have excess securities, and you're short of funds, you can pledge those securities and borrow against them. Now, say for example, if you want to get a housing loan, what you will do is you will pledge a property that you own, or you might buy a property and pledge it to the bank, right? So in this case, the property that you bought is an asset. An asset can be pledged for a borrowing. So if you have your own treasury bills and bonds which you own, which are your assets, you can pledge them as security and borrow against them. Right? That's called repurchase agreements or repos. Interest rates are usually lower than clean borrowing because it is backed by a security. Repos are backed by a security. So the interest rate is lower than clean borrowing. Reverse repos is the opposite of repo. If you want to lend and you are not willing to take credit risk, right, you can use reverse repos. Right. Now this is the opposite of repurchase agreements. If you want to lend, you can use reverse repos. If you want to lend against a security, right? Not clean lending, but lending against a security is called reverse repurchase agreements. An entity with surplus funds can lend against treasury bills and bonds. Such lendings are more secure than clean lending. And the yield curve is a line that plots the interest rate at a set point of time of bonds having equal quality but differing maturities. Right? So equal quality, differing maturities. That means usually the same issuer. Okay, now if you take, if you assume that the issuer is the Sri Lankan government, you have treasury bill, 1 year treasury bill rates going at, well, 3 month treasury bill going at around 4.7, 6 months going at about 4.8, and 1 year treasury bills going at about 5.1, right? Then the 2-year bond is going at about, let's say, 6%, and 7-year bond, a 5-year bond is going at about 7%. 10-year bond might be going at about 8%. So likewise, the same issuer, but various tenors. If you plot each of the returns that are generated across the tenors for the same issue, it's called a yield curve. How much of return can you get by investing in the same issuers, different tenors of the same issue? Then there are 3 types of yield curves. First one is the normal yield curve. Normal yield curve is a shorter term debt instrument which have lower yield than longer term, right? So the normal yield curve is where short term debt has low yield, low interest rates than long term debt. Higher yield required by investors of long term debt due to risk associated with time. So long term investors will need a higher return to compensate for the additional risk of investing long term. Then the flat yield curve is the difference between short term and long term rates for bonds of same quality is very little. Can be seen during transitions between normal and inverted. Now, flat yield curve is something that is given like this in the next diagram, next page. Now, in a normal yield curve, you have lower short-term rates and higher long-term yields. Whereas flat across all tenors, you will have almost the same interest rate or the same return. Inverted is where long-term interest rates are lower than short-term interest rates. Now, my question is, why do you have different shapes of yield curves? Different shaped yield curves. Why do yield curves have different shapes? What do you all think? Why would there be different shapes of yield curves, different kinds of yield curves? Why are some normal or upward sloping, some are flat, others are inverted? Why? Because if you take the normal yield curve, right, lower tenors, shorter tenors have lower interest rates, lower yield, and longer tenors will have a higher yield. Why? Because if you are an investor, right, and currently interest rates are low, isn't it? Interest rates have come down, and you're looking to invest money. You feel interest rates will go up, right? If that is the case, you would prefer to invest long term or short term. If you feel interest rates will go up, you will prefer to invest long term or short term. Yeah, you're right. Yes, Dinesh and Maki, you nailed it. Yes, you feel interest rates will go up, meaning there is no point investing funds long term because you can invest after some time at a higher rate. Right? So there's no point blocking your money right now at low interest rate. So you prefer to invest short term, and it will not only apply to you, but all other investors. They will prefer to invest. Most investors will prefer to invest in the short term, meaning the supply of funds in the short term will be very high. Everyone wants to invest short term, but not many would want to invest long term, right? But everyone wants to borrow long term. No one wants to borrow short term. So short term supply is high, demand is less. Long term demand is high, supply is less, which is why the yield curve is upward sloping. Short term, low demand, high supply. Long term, high demand, low supply. So long term prices will be higher than short term prices. Then the flat yield curve. That is because you don't expect interest rates to change much, right? You're indifferent between investing long term or short term because you don't expect lots of interest rate movements. So you're indifferent. You can invest for any tenor that you want. That's when the yield curve is flat. Inverted yield curve. You expect interest rates to go down, right? Interest rates to go down. If that is the case, you will prefer to invest long term or short term. Yeah, you're right, Dinesh. If you feel interest rates are going up, you prefer to invest long term, right? So long term, so you will prefer to invest long term, right? So long term supply is increasing. Long term supply will increase. But if you're a borrower, you will want to invest short term or long term. If you feel rates are going down, if you're a borrower and you feel rates are going down, you will want to invest short term or long term. You'll want to borrow short term or long term. Short term. Yes, Sonali, you're right. If you feel rates are going down and you're a borrower, you will prefer to invest short term, right? But you're an investor, you will prefer to invest long term. Now, long term, if you're in, all investors will prefer to invest long term, meaning supply in the long term will increase, whereas demand in the long term is less. Short term demand is high, but short term supply is low, which is why your yield curve will be an inverted one. Short-term supply is less, demand is high. Long-term supply is more, demand is less. Right? So that's when you get an inverted yield curve. Now your yield curve will be upward sloping if you expect interest rates to go up, right? Now interest rates will go up if generally if the economy is doing well and it's progressing. So there will be a natural increase in interest rates if an economy is performing to standard, to expectations, right? But if you expect the economy to slow down, if the economy is going to contract, everyone expects the economy is going to contract, then you get an inverted yield curve. Right? Yield curve changes. So this shows the yield curve of a US bond, starting from 3 months and going up to 30 years. Theories of the yield curve. So like most other things, even yield curves have their own theories. Expectations theory. Expectations, like what we explained just now, your expectations of interest rate movements. Investors have no maturity preference, right? So these are the assumptions. You're indifferent whether you want to invest long term or short term, but you go purely by sentiment. They risk neutral on maturity, but do have expectations about future levels of interest rates. Either they feel interest rates will go up or go down. Expectations for higher rates leads to a positively sloped yield curve. Right? Higher rates expectation means everyone will want to invest short term and borrow long term. So long term demand is high, long term supply is less. Right? That's when you get a positively sloped yield curve, because you expect interest rates to go up in the future. If that is the case, you will want to borrow long term and invest short term. So short term supply is high, demand is low. Long term demand is high, supply is less. So you get an upward or positively sloping yield curve. Expectations for lower interest rates will lead to a negatively sloped yield curve. If you expect the economy to slow down and interest rates to go down, then you will want to borrow short term, lend long term. So long term supply increases and short term demand increases. You'll end up with a negatively sloped yield curve. Expectations of unchanged rates will lead to a flat yield curve. The short term rates will be equal to long term yields. In liquidity preference theory, investors sacrifice yield in order to obtain liquidity. So it assumes that most investors will prefer high liquidity as opposed to high interest rates. Investors prefer liquidity and borrowers prefer long-term funds. Right? So it says that investors prefer liquidity. If you are an investor, you will not want to put your money in an investment which is illiquid, right? Whereas borrowers want long-term funds. If you are borrowing, you want the longest possible time, isn't it? Now take your credit cards for example. Right? You will prefer if you have uh, well, normally credit cards give about 1.5 months credit period, but if you have 3 months credit period, you'll be all delighted, very excited. Because as a borrower, you will want long-term funds. So long-term bonds are less liquid than short-term bonds. A bit of a spread and greater price volatility. So long-term bonds are not as liquid as short-term bonds. Now, one of the most liquid bonds is the US 3 months Treasury bill, one of the most liquid assets. Liquidity premium leads to a positive slope. Upward yield curve does not necessarily imply interest rates will go up in the future. So the next theory is called market segmentation theory. There are two groups of investors: commercial bank and insurance companies. Commercial banks and insurance companies. Now, banks have relatively lower liabilities. Their liabilities are shorter tenor compared to banks, whereas insurance funds have long-term liabilities, long-term life funds that can run about 20, maybe 30 years life fund. But banks have relatively lower assets, lower maturity assets. The maximum tenor of an asset that the bank will have is usually about 10, 15 years, maybe maximum 20 or 1,000 years, unless they're staff. Whereas insurance companies will have longer liabilities, right? Because most of the life policies will be running for very long term, maybe 20, 30 years. Investors have preferred segments dominated by their liabilities. Right. Now, if you want to invest these days and you have excess amount of borrowed funds, you might prefer to invest in the stock market because the stock market is doing well. Whereas if you invest in FDs, you get 5-6%, which is below your borrowing cost. Neither borrowers nor investors are willing to shift from one sector to other, right? So if you are a borrower eternally, until you die, you be a borrower. If you're a lender, for as long as you keep lending, you will want to invest in such type of instruments. So the shape of the yield curve depends on demand and supply of securities within the sector. Also, the shape of the yield curve also has an impact on demand and supply. In credit ratings, very crucial. Because we saw Sri Lanka, our one sovereign rating getting downgraded, right? It was downgraded from, if I'm not mistaken, from B plus to double C plus. So there are two types of investments, either investment grade or non-investment grade. Two types of investments: investment grade and non-investment grade. You also can also call this junk. Now, what is the highest possible investment grade? Highest possible investment grade. What is the highest possible investment grade? Highest possible investment grade is what? Yes, any idea, guys? What is the highest possible investment grade? You won't get an investment grade higher than that. Now, what are the rating agencies? These ratings are assigned by certain agencies. Credit ratings are assigned by what sort of agencies? Examples. The credit ratings are assigned by examples of agencies that assign credit ratings. Now, your respective banks are rated by whom? Or rating agencies. Examples of rating agencies. Yes, very good. Can be by Fitch. Who else? Moody's. And to be from Fitch, Moody's. Oh, what? Very good. S&P. And locally we have ICA. Right. So what is the highest possible investment grade? Highest possible investment grade? Yeah, very good. AAA. What is next? What comes after AAA? Almost there, it's AA plus. Then you get AA. AA minus, A plus, A minus. Then triple B plus, triple B minus. And so what is the lowest possible investment grade? Lowest possible investment grade. The lowest possible investment grade is triple B minus. Triple A is the highest possible investment grade. Triple B minus is the lowest investment grade. Anything below triple B minus is classified as non-investment grade. Now, what is the highest non-investment grade rating? Highest non-investment grade rating the highest non-investment grade rating. Is double B plus. Then comes double B minus, B plus, B minus, and triple C plus. Triple C minus. So that's how investment grades go. And of course, it goes down further, and C plus, C minus. Okay. Now, what's important is as you go from AAA credit rating downwards, what increases? What increases as you go from AAA downwards? Default risk increases, exactly. Right? So as you go down, your risk will increase. Okay, slight correction is due in the tute. Investment grade lowest will be triple B minus. Then factors affecting overall government security returns. In other words, what affects interest rates, right? Macroeconomic factors, things like the macroeconomy, political stability, the plus factors basically, political, legal, economic, social, and technological, right? What is happening in those fronts? So when we see when there is political stability, interest rates tend to stabilize, and if there is more uncertainty, then interest rates tend to go up. Likewise, legal and regulatory factors. What are the legal guys doing? What are regulators doing? Are they trying to bring down interest rates, push up interest rates? Economic factors, GDP growth, unemployment, exchange rates, commodity prices, right? All that can have an impact on interest rates. Monetary and fiscal policy. So monetary policy is where central bank decides on interest rates. Fiscal policy is where the government decides on taxes, government income and expenditure. Stock market returns. How is the stock market doing? If the stock market is doing well, we might see investors moving out of bonds and getting more into stocks. Geopolitical factors. What is happening in the international front? Are we getting along very well with our international relationships? In the liquidity in the market, usually when liquidity is very high, interest rates tend to remain low. And if liquidity starts dropping, then interest rates start going up. Okay, so let's try this example. Which is on discounts. How do you find the discount rate? A lender has bought a paper at 100 rupees for 1 year and receives 110 in 1 year's time. So he has bought it for 100 and he will receive 110 in 1 year. Interest rate very simply is 110. Okay. So it's like simply placing FD for 1 year. Placing a 1 year FD, you invest 100, when it matures, you will get 110. Right? So very simply, you have got a return of 10%. Your return is 10%. Another way to look at it is the investor had bought a paper at discount to the face value of 110. 110 is the face value, right? And he's investing 100. That means the price in this case is less than face value, so he's buying it at a discount, isn't it? Right. He has got a discount of $10 on a face value which is 110. Right, so his discount rate as a percentage of the face value will be 9.09. So this is the present value. You will get the future value. Discount is R. The discount discount is, sorry, as a percentage of face value. That's how it goes. Now, by any chance, if this was a short tenor, let's say it was a 91 days, right? If it was 91 days, then what you do is you need to annualize your answer. Right? So you got a discount of 10 on a face value of 110 for a period of 91 days. So for 1 year, what is it going to be? Roughly about 36.5%. Right. So any questions up to now? Okay, so no questions. Let's try this. First question is, a bank buys a treasury bill on 12th June for 4871,083. The government is due to pay back the value of 5 million at maturity on 11th December. What is the discount the bank received and what is the discount rate? Right. On 12th June, $4871,083. Then when it matures on 11th December, how do you calculate? So the first thing is to figure out how many days between 12th June, 11th December. 12th July, 12th August, 12th September, 12th, and sorry, I'm running out of space. So let me extend this a bit. 12th October, 12th November, and 12th December. So it's 11th. And so the number of days, 12th June, 12th July is 30. July to August, 31. August, September is 31. September, October is 30. Then October to November is 31. November to December is 30, but you're taking 1 day less, so it's 29. This is plus, 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 plus. 182 days, 182 days. So the discount the bank received, discount is the face value minus the present value. So it's 5 million minus 4871,083. One two eight nine one seven. Discount rate is the discount divided by the face value into number 3 is 182 over 365. Do you get 5.17%? Do you guys also get 5.17%? Okay. Right. So any questions up to now? Very well. Let's move on. So the rate of return. There are two types of rates of return. First one is yield to maturity, which is a forward-looking approach, and holding period return, which is a backward-looking approach. Right? You can calculate two types of returns. Yield to maturity. If you hold this bond until it matures, what is going to be your return? And the holding period return, which will calculate your return whatever period you had held it on for. Right? That's a backward-looking approach. Now that, remember, is based on not the face value, but the investment amount. Right? So shall we calculate the returns in these examples? Let's try these examples and calculate returns. First one, a bank takes a deposit of 1 million from a customer on 22nd July and commits to pay back 1,025,205 cents 48 on 22nd October. What is the yield to the customer? The bank takes a deposit of 1 million from a customer on 22nd July and commits to pay back 1,025,105 cents 48 on 22nd October. So the number of days between these two of this. So 22nd July to 22nd August, 31 days. 22nd August to September is again 31. September to October is 30. Total comes to 92 days. Right. So we have the investment amount, maturity amount, and the number of days. Question is, what is the yield to the customer? Right. Read the question carefully. It says yield. Previously, we calculated discount. Now we need to get the yield. So remember, discount is based on the face value. Yield is based on your investment. Right? Because the yield is your return on investment. Discount is of the face value, how much of discount you're getting. Yield will be the future value minus present value divided by the present value. It's a percentage of present value into number of days, 92. So the future value is 1,025,205 cents 48 minus the present value of 1 million over 1 million into 365 by 92 into 100%. This is 25,205 cents 48 over 1 million into You get 10%. Do you all get 10%? And see, if you were to calculate the discount, it would have been based on the future value, whereas this is yield. It's based on your investment. You get 10%. So let's move on to the next question. It says a bank buys a treasury bill on 12th June for 4871083. Government is due to pay back the face value of 5 million at maturity on 11 December. What is the yield to the bank? So remember, this is yield, not discount. You need to be mindful of what the question is testing, whether it's yield or discount. Your computation method will change. Bank buys a treasury bill on 12th June for 4871083. The government is due to pay back the face value of 5 million at maturity on 11th December. Face value of 5 million. Question is, what is the yield to the bank? Right, so we calculated the number of days earlier, 182. You asked to calculate the yield. Did you all try? $5.3. Okay. Yield would be face value minus present value over present value into 365 over 182. Future value 5 million, present value 4871083. Present value is 4871083. Yes, Varuni, you are right. You get 5.31%. Any questions? Simple, isn't it? No questions. Right. So how do you go from discount to yield? Now, yield can be calculated as the discount rate over 1 minus the discount rate in number of days divided by the day count basis into 100. Right. Shall we try this? We have the yield in this example, so let's calculate discount. Right? So you don't have to memorize this equation. If the yield is 5.31%, let's calculate discount. Number of days 182. Day count is 365. Into 100. It actually helps if you remove the percentage sign. If you don't have the percentage sign, so you get 5.17. Am I right? Did you all get this answer? Yeah. Now it's important to understand the difference between discount and the yield, right? So in other words, yield means if you invest $100, how much can you expect when your investment matures? What is your actual return? The tangible benefit you derive out of your investment. It's like the return on investment. How much of return can you expect from your investment? That is what yield means. And remember, yield has to be annualized. You always express percentages, yield percentage, as an annual figure, right? Not for 90 days or whatever. It is always an annual figure. So if you say 10% yield, it means if you hold an investment for a period of 1 year, you should get a return of 10%. Right? Whereas discount means on the face value, how much is taken off, right? So if an investment is worth 100 rupees, which you will receive in 5 years, how much of a discount are you buying it for today? Or if it's worth 100 rupees in 1 year, what is the discount you get when you buy it today? It's called a discount. It's the discount you get on the face value. How much of a discount on the face value? Whereas the other one is the return that you generate. on the investment. Yeah. I hope that is clear. Right, so this is a simple cross multiplication which you would have done in trade 2. Right, any questions? If there are no questions, we can, yes, time is up, so we can wind up for today. And remember, we will meet on the 26th, right, for a day at 1 o'clock. Okay, guys, so thanks. I will see you on the 26th.